Silver just dropped 17% in one trading session. I need you to really grasp how massive that number is. 17% in a single day. Throughout Asian market hours, we watched silver collapse towards $73 per ounce before pulling back to roughly 11% losses by the time European markets opened mid-morning. That brief two-day rally everyone thought meant we'd hit rock bottom? Completely wiped away. We're sitting more than a third lower than the record peak above $120 we saw just last week. Gold's experiencing wild swings, with a 3.5% decline. Copper's falling beneath $13,000 per ton. Every precious metal is facing intense downward pressure, and the information I'm analyzing right now is critical for anyone invested in these markets to understand before trading resumes. I'm going to explain precisely what's unfolding and why it's so significant. Leave a comment telling me your location right now. Which country are you in? What city? I'm curious to see just how international this audience is. And tell me your current strategy with silver holdings. Holding tight? Adding to positions on this decline? Exiting? Were you forced out by stop losses? Share your actual situation in the comments section. Let me connect today's action to the bigger picture we've been monitoring. Last month, silver exploded past $120 in an unprecedented surge. It appeared unstoppable at the time. Shanghai was showing premiums reaching 40% over COMEX pricing. Physical metal was nearly impossible for dealers to obtain. The upward momentum seemed invincible. Then we hit last Friday. Silver experienced its most severe single-session decline in market history, the biggest one-day crash silver has ever seen. Gold recorded its sharpest drop since 2013. That should have been the final shakeout, the capitulation moment. When we saw that two-day recovery afterward, people assumed we'd established a bottom. That assumption was wrong. Today's 17% plunge demonstrates the sell-off hasn't run its course. We haven't identified a support level yet, and this extreme volatility shows no signs of ending. Here's what Saxo Bank analysts stated, and I think their assessment perfectly describes our current situation. Significant selling pressure appeared in Chinese futures trading and CME markets after resistance at $90.50 couldn't be broken. Silver will likely keep experiencing violent price swings in both directions until market functioning improves with reduced volatility and enhanced liquidity. That's their exact wording. Violent price swings in both directions. Professional analysts don't choose such language casually. This is their way of warning us we're operating in an environment where typical market behavior doesn't exist, where price movements that normally unfold over weeks are compressing into hours, where volatility feeds on itself and multiplies. Here's the sequence that caused today's collapse. Following Friday's devastation, silver attempted a recovery. We saw 2 consecutive days of gains. Market participants began thinking perhaps the worst had passed. But as price climbed toward $90.50, it encountered fierce resistance. Selling pressure crushed buying interest. After that resistance level proved solid, algorithmic trading programs initiated sell orders. Momentum flipped direction, and we witnessed another avalanche, another round of forced position closures, another session with 17% declines. Goldman Sachs published research that's essential reading for anyone holding silver. They highlighted how depleted inventories have generated conditions resembling a market squeeze. What's the implication? When buying demand emerges, available supply gets absorbed rapidly and prices shoot upward. However, when supply constraints ease and selling begins, prices plummet just as dramatically. This cuts both ways. The identical circumstances that enabled silver's climb to $120 are now enabling its drop to $73. Minimal inventory magnifies price movements in either direction. There's no shock absorber, no safety margin. Individual buyers and sellers move prices disproportionately because the market lacks sufficient depth to handle the transaction flow. Quick question for you. What's the current time where you're located? Morning hours, afternoon, late night? Drop your answer in the comments. I find it fascinating to learn when viewers are watching this content. Are you reviewing this before market open to strategize? Are you watching after trading closes, trying to process what happened? Tell me. something extremely important is being severely overlooked. The chaos in silver has complicated trading operations for the major banks controlling London's over-the-counter spot markets. These banking institutions are discovering it's increasingly dangerous to maintain either long or short positions, even for brief periods. These entities are the market makers. They're the large institutions providing market liquidity. They're the trading partners that enable market operations to continue smoothly. And they're withdrawing from the market because volatility has become too dangerous for their risk management systems. What's the result when market makers withdraw? Liquidity evaporates. And when liquidity disappears, volatility escalates further. We're stuck in a reinforcing cycle. Extreme volatility forces banks to cut their market exposure. Reduced exposure drains liquidity from the market. Decreased liquidity generates more volatility. The cycle continues repeating. This explains Saxo Bank's prediction that silver will keep experiencing violent swings in both directions. The market's fundamental structure is currently dysfunctional. Returning to normal conditions will require time, and until that happens, we should anticipate unpredictable outcomes. Another critical factor isn't receiving adequate attention. Trading professionals report that elevated price levels have created strain on credit allocations for precious metals trading desks. Let me translate that into everyday language. Financial institutions operate with credit limitations. They designate specific capital amounts for precious metals trading activities. When prices rise and volatility increases, maintaining each trading position demands greater capital commitment, higher margin requirements, increased collateral, larger risk buffers. When credit allocation remains constant but per-trade capital requirements expand, the number of possible trades decreases. Liquidity provision drops. Market participation declines. This dynamic is active right now. Credit restrictions are constraining the liquidity banks can supply to the market, and this liquidity shortage is amplifying volatility while increasing derivatives trading's influence on prices. We're seeing the derivatives market drive the physical market instead of the reverse relationship. This isn't a healthy market condition. This isn't sustainable long-term. But this represents our current reality. Let me provide context on what initiated this entire unwinding process, because understanding root causes helps anticipate future developments. Precious metals broke all previous records throughout the past year. The rally was fueled by central bank accumulation, substantial exchange-traded fund inflows, speculative momentum particularly from Chinese markets, geopolitical instability, and worries about Federal Reserve independence. Investment capital shifted away from government bonds and paper currencies toward tangible assets. This investment thesis performed exceptionally well into January. Then, President Trump announced Kevin Warsh as his Federal Reserve Chair nominee. Financial markets interpret Warsh as adopting a more hawkish monetary policy stance, and this nomination sparked a dollar recovery. The U.S. dollar index, measuring the dollar's value against other major world currencies, began advancing. When the dollar strengthens, dollar-priced commodities like silver become costlier for international purchasers. That's straightforward market mechanics. Stronger dollar equals weaker commodity valuations, assuming other factors remain equal. The dollar's rebound initiated broad profit-taking behavior. Investors holding substantial positions accumulated during January started liquidating. And once liquidation began, it triggered a domino effect. Investors had established massive precious metals positions. They'd utilized leveraged exchange-traded products. They'd purchased significant quantities of call options. This entire exposure amplified the upward price movement and magnified the downward movement even more severely. When prices started declining during Asian Trading Friday, it unleashed a selling wave that extended through early this week. That selling wave generated exceptional market volatility, and although we saw a two-day bounce, selling pressure hasn't been fully released. Today's action confirmed that. Question for everyone watching. Did you use leveraged instruments during silver's rally? Leveraged ETFs, futures contracts, options? Share in the comments. I'm asking because understanding audience exposure patterns helps me provide the most relevant analysis. If you experienced losses from leverage unwinding, you're far from alone. Leveraged positions worth millions of dollars have been liquidated these past several days. It's painful, but it offers important lessons about position sizing and risk controls that need discussion. I'll present the bearish perspective first, because if you're only absorbing bullish viewpoints right now, you're missing the full picture. The bear case is simple and compelling. Silver has fallen more than 1/3 from last week's record high. That's not a standard pullback, that's a market crash, and crashes frequently continue downward. The attempted recovery failed. Silver reached resistance at $90.50 and faced aggressive rejection. Failed rally attempts typically lead to fresh lows. Current price behavior suggests we haven't established a bottom yet. CME Group increased margin requirements. This action raises position maintenance costs and generally pressures prices and trading volumes downward. Anyone maintaining leveraged long positions now faces elevated costs for holding those positions. Many lack sufficient capital. They'll face forced liquidation. Additional forced selling creates more downward pressure. The dollar is gaining strength. The dollar index rose 0.3%, reaching 97.89. A strengthening dollar creates headwinds for precious metals. Market liquidity has vanished. Banking institutions are reducing market-making activities. Credit constraints are limiting trading operations. In low liquidity environments, prices can overshoot dramatically in either direction. But during downtrends with forced sellers present, low liquidity produces faster and deeper price declines. Goldman Sachs issued warnings about thin inventory levels, creating squeeze dynamics that function bidirectionally. The identical mechanism that pushed prices upward is now forcing prices downward. No support floor exists because market depth is absent. Saxo Bank stated explicitly that silver will continue experiencing violent bidirectional trading. Professional market analysts, whose careers involve studying these markets, are warning that additional volatility is approaching. This signals ongoing turbulence ahead. Industrial consumption might be declining at current pricing levels. Previous reports showed industrial purchasers, including Chinese solar panel producers, were seeking silver alternatives when prices were elevated. If industrial demand weakens, one major pillar supporting the fundamental bull thesis weakens. Now I'll present the bullish perspective, because bearish analysts aren't providing the complete narrative either. The crash resulted from forced liquidation, not fundamental value selling. Goldman Sachs verified this in their research. When prices fell, dealer hedging behavior shifted from purchasing during uptrends to selling during downtrends. Stop-loss orders activated, cascading losses occurred. This represents mechanical selling. When forced selling depletes itself, prices frequently rebound violently. Silver currently trades at levels representing over 35% discount from recent peaks. Every significant commodity bull market experiences violent corrections throughout its duration. 30% declines, 40% declines. They're normal occurrences. They eliminate weak holders. They redistribute assets from short-term speculators to long-term accumulators. Then bull markets continue. Silver's fundamental investment case remains unchanged. Solar energy demand isn't vanishing. Electrification expansion isn't decelerating. Supply shortage issues aren't resolving. The long-term structural investment thesis hasn't altered. What changed was excessive speculation got eliminated. Global physical demand stays robust despite paper market price crashes. Earlier reports documented dealers having difficulty sourcing physical metal. Premium pricing persisted in major markets. When physical buyers continue appearing at these price levels, it establishes a support floor that paper selling can't permanently breach. Central banks keep accumulating gold at unprecedented rates. This trend hasn't reversed direction. The de-dollarization movement hasn't been invalidated. The factors that drove investors toward precious metals throughout the past year remain present. Geopolitical uncertainty continues. Currency debasement concerns continue. Consider this question carefully. If silver seemed attractive at $120, does it seem more or less attractive at $73? The fundamental narrative hasn't changed. Only pricing has changed, and current prices are 35% lower. How many viewers are long-term physical accumulators versus short-term paper traders? Share in the comments. Are you building physical metal positions over years and decades, or trading paper instruments attempting to profit from short-term price movements? Your answer should determine how you interpret everything I'm explaining. Let me outline what to monitor over the coming 24 to 48 hours. Monitor the $73 price level. That marked today's intraday low. If silver breaks decisively below $73, it creates potential for additional downside. The next significant support zone would likely fall between $60 and $65. Monitor $90.50 during any bounce attempts. That's where today's recovery attempt failed. Heavy selling emerged at that price level. It's now established as resistance. Any credible recovery requires silver to reclaim that level. Monitor the dollar index movements. Monitor gold's price action. Watch for announcements from major financial institutions regarding their precious metals trading operations. Watch for CME margin requirement updates. These indicators will reveal whether market conditions are stabilizing or continuing to deteriorate. Volatility doesn't have inherent direction. High volatility doesn't predict downward price movement. It predicts price movements exceeding normal ranges in both directions. The same conditions generating 17% down sessions can generate 17% up sessions. If you can tolerate this volatility level and maintain appropriate position sizing, opportunities exist here. If you can't handle this volatility or you're excessively leveraged, this environment will be devastating. Precious metals rallied throughout the past year for legitimate reasons. Central banks were accumulating. Investors were reallocating away from bonds and currencies. Geopolitical risks were intensifying. Federal Reserve independence concerns were mounting. All these factors remain active. What this crash accomplishes is separating speculators from genuine investors. Speculators are experiencing account destruction. Leveraged traders are facing liquidation. Momentum chasers are suffering severe losses. After speculators exit, investors remain, and investors purchase undervalued assets. 3 critical conclusions. Silver crashed an additional 17% today, eliminating the 2-day recovery. We're now more than 1/3 below last week's record high. Professional analysts confirm selling hasn't concluded. Additional volatility is coming. Position your portfolio accordingly. The market's operational structure is currently broken. Liquidity has evaporated, and this liquidity shortage is generating additional volatility. These aren't standard market conditions. These represent crisis-level conditions. Expect unpredictable outcomes. Silver's fundamental investment case hasn't changed. Solar demand continues. Electrification continues. Supply deficits continue. The factors that attracted investors to precious metals throughout the past year remain valid. For long-term investors, this volatility represents opportunity. For short-term traders, this volatility represents severe risk. Markets don't function rationally short-term. They're controlled by fear, greed, leverage, and forced liquidation. What we're witnessing right now demonstrates all 4 forces combining to create historic volatility levels. $120 dropping to $73 within days. That's the mechanical unwinding of leveraged speculative positions in a market lacking liquidity. Eventually, mechanical selling will exhaust itself. Eventually, liquidity will return to the market. Eventually, prices will reflect fundamental values rather than forced transaction flows. The critical question is whether you can maintain your positions until that transition occurs. Conduct your own research, fully understand the risks, accept responsibility for your decisions, develop a clear strategy, and define your investment timeframe. Plan and position your portfolio accordingly. Share your perspective in the comments. Where are you located? What's your current strategy with positions? Are you adding to positions during this decline or waiting for clearer signals? I review every comment and they influence future content. The volatility hasn't ended. Expect significant price movements in both directions ahead. Stay alert, stay informed, and base your decisions on analysis and logic rather than fear and emotion.